Hello. Today we will talk about long-term assets, fixed and intangible assets. This is Module 5 of Financial Accounting. Now, we've talked about assets in previous chapters. Today we're going to focus our energy on assets that are long-term, that pretty much are permanent, and they're going to be in the long-term section of our balance sheet. Some examples of long-term assets obviously will be equipment, which you will probably see on your project, but it also includes machinery, buildings, and land. So these assets have some characteristics. Obviously, they're tangible. You can touch them, you can see them. But they definitely are used for the organization's normal operations. And in the case of our project, we have equipment, and that equipment is generally going to be used to create these treats for dogs, for animals, for example. And they are not offered for sale. They're not inventory, which is very important to make that distinction. This is we're not talking about inventory in this case. We're talking about assets that we use to generate more revenues, but it's not the revenue in producing itself. We're not selling it to our customers. And it's important to know that distinction. Um, the cost that now there are some costs related to fixed assets that may very well have to be delineated or separated. And again, we're talking about how can we record our assets, what's the amount that we're going to charge or we're going to put on our balance sheet. It's generally going to be the cost of that asset and what we need to spend to bring that asset to its use. Sometimes it includes the sales price clearly, but also the sales tax, the freight or installation costs. And if you're buying a building, it could very well be the cost associated with closing, title and legal and all of those kinds of costs. All of those are very much involved with what the cost of that asset is and what you record on your books. So, is it going to be long lived? Again, long lived is over a year, clearly. If it's something that's going to be over a year, chances are it is more certainly a long lived asset. In this case, a long lived fixed asset. Is it used in normal operations? And the answer is yes. When you talk about the equipment that patent approved uses, it's most certainly going to be a fixed asset. But if it's not, it's going to be an investment. I would say in the case of this chapter, we're going to be really focusing on those assets that are going to be used for operations, in which we will take those costs and spread them over the life of that asset, over its useful life, for purposes of depreciation and the matching principle. So it's very important, those two questions. And they're not very, very complicated. To just make certain that you know that this asset is going to be a fixed asset and it's not going to be an investment, and knowing how to make that distinction. So assets are going to have a lifespan, long-term, long-lived assets are going to have a lifespan that's longer than a year. And that's very, very important. Current assets like inventory is going to be something that you're going to be using to sell to your clients. And most certainly, the quicker you get them sold, the better off you are. So they're very, very liquid assets. Liquid current assets, I have to say. Investments are long lived, but they're not used in normal operations, and most often they're used to maintain, to purchase for purposes of increasing the value of that asset. So you can, when you do later sell it, you sell it at a gain. So these are investments, and they are most certainly going to be held for a while, sometimes over a year, but in the end, they're sold. And they're sold for the purposes of gaining the appreciation, the changes in value, upward changes in value for that assets. So as I mentioned before, cost to prepare that asset for its use is going to be the cost that you record on your books. And that includes obviously sales tax and installation costs and packing and all that kinds of things that you'll need to ensure that that asset is in its proper, it's actually available and ready to be used. Cost that does not increase its usefulness, does not extend its life, will be expensed. And we have some examples here. Again, repairs and maintenance. If you want to repair and maintain it, that's not going to increase the life, because some assets wear out. And by replacing various things like a vehicle, if you use your vehicle for your organization and then it's a fixed asset and it's a long-lived asset, replacing the brakes is not going to be something that you're going to capitalize. You're not going to record the cost of that and add to the value of your asset. It's actually just maintaining it. It's not going to extend the life. It wears out. So essentially, you're going to be expensing it when you record those kinds of costs or expenses. So direct costs for the construction of a fixed asset includes labor, materials. All of this stuff is very, very, you know, common sense. If you're going to construct your asset, everything that's involved in that process is going to be added to the cost of that, or to that asset, and it's going to be put into a construction in process until that asset is actually complete and put on your books as a fixed asset. This course here does not focus, this particular course does not focus on the allocation of costs associated with construction, but it is a course that is taught, and it's important to understand the basis upon which where these numbers come from. When you're building an asset, you're constructing an asset, and until that asset is actually completely built, it's going to sit in an account called construction in process until it's done. And a lease is also, it's very important to know, for some leases are not considered rent. And that's important to make a distinction between when you get into a building and you're using it for your operations and you pay a landlord $1,500 a month. That's not a capital asset, and it's not going to be an asset on your books. It's going to be a downright expense. However, there are some leases when you purchase some type, or you get some kind of equipment and product, you don't buy it outright. You pay for it as a lease, and at the end of that lease, you either buy that asset, or you give it back to who you lease it from. In cases like this, a lease can be very much like, or in this case, a contract, an asset, a fixed asset. And again, these are some conditions where a lease contract will be considered a fixed asset. The party who owns the asset and the party whom the rights to use it are granted rights to use that property. But leases as an asset has some very, very significant advantages, and it makes it very different from just leasing a car and give the car back, or buying the car outright. It has some advantages. Obviously, you have access and you can use the funds or use your money to buy that asset. You also have repair and maintenance costs that may be responsibility of the lessor. You don't have to worry about that. Again, you don't own the product or the asset. Risk additional costs for it being obsolescence, or it's not going to be useful anymore. Again, that kind of risk is kind of shifted because you're not going to have this asset for a long time, and it not being useful to you because it's obsolete. It's not really a problem because you're never going to own it. You're just going to have a leasing contract. The asset you can use, but at the end it is the lessor's asset, and when that lease agreement is terminated, the asset goes back to them, or you would then purchase that asset. So what we want to focus on in this chapter really is understanding when we have an asset, a long-lived asset, a fixed asset, we need to take that asset and record it at its cost, what it costs us to bring it into service. Okay, but we also need to take that cost and spread it over the life of that useful assets. And what that means is we are essentially matching the use of that asset with the revenues that asset will generate over future periods. So, and we do that through depreciation. There are many different ways to depreciate your asset, but the main point I want to make clear here is why we depreciate our assets. Why do we depreciate fixed assets? And the reason is because we want to take the cost of that asset, being $5,000 or $10,000, and we want to spread over its useful life and match that expense or that incurrence or that use of that asset to the periods in subsequent years that asset will be useful to us. And that's called depreciation. And depreciation is the process of systematically allocating the cost of an asset over its useful life. So in that case, we are going to define depreciation. We're going to record the depreciation expense because we're going to allocate that cost over its useful life. Remember, it has to have a finite life. Anything that does not have a finite life, like land, will not be depreciated. So, physical depreciation includes wear and tear and use of that particular depreciation. Functional depreciation is going to be obsolescence, changes in customer needs, and so forth. So one of the things we need to make certain is we're not talking about the value of that property going down. We're talking about how that particular property is being used, and how we depreciate it is going to be truly how we the use of that asset, how we're going to allocate that asset's use, not its value. So if we're going to use that asset systematically over 5 years and we decide to spread it out evenly over the 5 years, more likely we're going to use a straight line method, but it does not in any way tell you how that asset is declining in market value. That's a wholly different answer, different question. We're just using it based on how that asset's going to be useful to the organization. If it's a if it's furniture, and an asset is expected to to last 10 years, we can relatively assume that if we use it in the same way, the depreciation over that life should very well be systematic and maybe fixed, and straight line might be appropriate. If we have an equipment item that produces a various numbers of items, we may depreciate it based on how many items that particular unit produces, and that shows us how useful it is, not the market value of that asset, but the use of it. And that's what a depreciation is. It's showing how we've used that asset and we're allocating that use in a form of an expense over its lifespan. So that's very important. So we're going to factors that we're going to determine that we use to record depreciation expense. Obviously, the initial cost, and we talked about determining what the initial cost is. Again, it's going to be whatever cost of that product and any cost associated with bringing that asset to its intended use. That includes sales tax, taxes, licenses, fees, installation charges, etc. Also, the expected useful life. Again, this is an estimate. No one knows with 100% certainty how long an asset will last. You have good idea depending on what the asset is. A car, for example, computers, for example. You may know kind of what a good lifespan would be for that asset, but again, it is an estimate. And also, the useful life. How long you're going to use it? How long will it last? And if there's going to be a value at the end. The residual is going to be what's going to be the value of that asset when I'm done using it. 3 years, 5 years, 10 years, or 30 years. And that's going to be your residual. So you need to have all three. And those particular items are going to be very useful because it's going to allow you to be able to compute the depreciation expense. Again, we talked about all of the costs of obtaining and make it ready for its use. Estimated useful life is going to be the length of time the asset will be used under normal operating conditions. And then the residual value is going to be the fixed value that that asset will be worth at the end. So if there are words called scrap value, salvage value, trade-in value, residual value, they all mean the exact same thing. Depending on what textbook that you have, that's going to be the term that it uses, but be certain it means the same thing. So the difference between the initial cost and its residual value was the depreciable cost. And again, we're going to talk about the different types of depreciation methods that you can use, just to know the terms and what they mean and how it's relevant to you when you're computing the depreciation expense. There are three methods that are very commonly used. I have seen units of activity or units of production method is called commonly, or straight line quite a bit. The double declining also is used, and we're going to talk about them. So straight line method is basically giving you your annual depreciation, and then you take that number and you're going to prorate it to the number of months, particularly in the first year of that asset's being put in service. But it's going to be the cost minus the residual value divided by its life. Very, very simple calculation. That number, which means straight line, is going to tell you it's going to have the same amount of annual depreciation over its useful life, with the exception of the final year of that asset's life. It may very well be prorated simply because you don't want to accumulate your depreciation that exceeds the residual value of that asset. That's very, very, very important when you're working on your homework and you're depreciating your asset over its lifespan, and the last depreciation is not the same as the previous month, particularly when it comes to straight line, you're wondering something's wrong. No, the last year of depreciation is going to be modified somewhat because you cannot depreciate beyond its book value or its residual value. So very, very easy to do, not a big deal. Just take your cost minus your residual and you divide it by your life, and there you have it. Now, again, computing your straight line into a rate is also important, because when you're talking about the double declining method, it's going to be using the straight line rate. The straight line rate is going to be 1 over the life times 2, or 1 over the life is going to give you the rate, and if you have double declining, you'll just take it and multiply by 2. So the straight line rate is 1 over the life of that asset. In the case of 5-year asset, you're going to say 1 over 5 gives you 0.2. That's going to be your depreciation percentage. An accumulated depreciation is a contra account. Again, it's a contra asset because it's going to be offsetting the asset, which is in this case a fixed asset. So it's going to be contra, it's going to be offsetting. And a contra account is going to have the opposite side, which means if your asset has a debit balance, your contra is going to have a credit balance. And it's very important to see that. The same is true then for a contra revenue account. Can you think of a contra revenue account? One comes to mind would be discounts or returns. Those accounts are designed to offset revenue, in which case revenue always has a credit balance. Therefore, your discount is going to have a debit balance. It's going to be offsetting. It is a contra revenue account. Just knowing what they are and what they mean and how they look on the financial statements can really be helpful to you. In the case of depreciation, you're going to have a depreciation expense, a debit, and then your offset or your credit is going to be accumulated depreciation. Your accumulated depreciation will be shown on the balance sheet as a contra to the asset to which it applies. So the difference between your asset's value or your cost, historical cost, and the accumulated depreciation for that asset is called your book value. Very important terms in this chapter, none of which are difficult to understand, but take the time to get used to these terms and what they mean, because when you're doing your calculations and your homework assignment is really important, and it does help you make sense of what you're trying to accomplish when you're computing your depreciation expense, when you're recording the journal entry, and when you're asked what is the book value at the end of 2 years, you can calculate it and you know what it absolutely represents. Units of production or units of activity provides the same amount of depreciation expense based on each unit of that asset. It's just depending on how many units that particular unit or that particular asset has produced, which gives you a different depreciation expense. But the factor that you'll be using will remain the same. Again, we will go through some details of that, or you'll go through some details of that as you're going through the your homework. But just remember, your whole goal will be, what does this particular method provide the user? It provides a depreciation expense, and it's calculated based on how many units that particular asset produces, versus using a straight line method and is allocating it the depreciation systematically over its life and the same depreciation amount over the period, and it doesn't change. So it's really units of production, units of output, very much a relevant method of depreciating your assets, and particularly when you're talking about assets that produce certain things. If it produces 100,000 units of an item, we are assuming that we're going to produce 100,000 units. In 5 years, we're going to do it. So each year, you're going to take a fraction of that total of number of units. That's going to be how you are going to be computing your units that you're producing. And we'll talk about that later. So if you are going to use this method, remember these 2 steps. So what we're going to do is we're going to calculate it. Very straightforward. This is another method that considers residual. It's very important to note that this method, as well as the straight line method, considers residual value in its calculations. So your numerator is going to be cost minus residual value, salvage value. And you're going to divide it by the number of units of activity. How many units is that particular product or that particular asset going to produce over its life? That will almost always be given to you in a problem. So for example, if we have an asset that is, let's do a calculation real quick, just to get an idea. If we have an asset that costs $10,000 and we have $1,000 of that asset as a residual value, that's our numerator. Then we say, okay, this asset is going to produce 100,000 units over its life. Now, let's think about it. What is the depreciation or the depreciation per unit for this asset, given these variables? So based on my calculation, I have a $10,000 cost for my asset. My residual value is $1,000. And then I divide it by 100,000, which is the amount of units that this particular item is going to produce. I come up with a depreciation rate of 9 cents per unit. Now, the next step then becomes we're going to compute the depreciation expense. Let's assume for the sake of this example, of the first year, we produced 10,000 units. So I'm going to take the 10,000 units and multiply it times 9 cents per unit. And I get $900 of depreciation expense. Very, very basic, not too hard to grasp. Think about what we did, and we'll go over this in just 1 second. Just think for a moment of how to calculate this one. So far, so good. Not bad. Okay, double declining method. And again, this one here is a more accelerated depreciation method, and it is highly effective in depreciating assets that you will get very much most of the benefit from that asset in the earlier years versus the later years. And it really depends on the asset, but we want to get the most depreciation in the first few years and then depreciate it less over the remaining years of the life. So you'll see this one's more accelerated. So double declining is going to be using the straight line rate. Now remember, we talked about the straight line rate. The straight line percentage is going to be 1 over its useful life. So let's use an example to do this. So if we use the same example here, we have an asset that costs us $10,000, and it is a 5-year asset, and it has a residual value of $1,000. So what do we want to do? We want to first calculate the depreciable straight line rate, 1 over 5. So I'm going to take my 1 using my calculator, divide it by 5. I get 0.20. And because it says because it says double declining, I'm going to take that rate and multiply it by 2. I get 0.40. That's going to be my rate that I will use for everything. Every time I record depreciation, that's going to be my rate. It will not change. However, we want to take and compute the depreciation expense. So step 1 and step 2 are already done. Step 3 then, compute the depreciation expense by multiplying the double declining rate times the book value of the asset. And remember, this particular asset is going to consider the book value. So the book value. Now, if we have a $10,000 asset and we have a residual value of $1,000, right now in the first year, the book value is $10,000. So I'm going to take 10,000 and I'm going to multiply times the rate I achieved was 0.4. And what I get $4,000 of depreciation the first year. Notice that my depreciation expense for the first year is very different from my units of production method, which I gave you an example of a few seconds ago. $4,000 versus $900 in depreciation expense. As I mentioned, this particular method, this double declining balance, is an accelerated depreciation method, and you will see the depreciation expense to be much, much higher than the straight line method. Let's take that same example and use the straight line method and compare that. We have an asset of $10,000. We have a residual value of $1,000. We have a 5-year asset. So I'm going to take the $10,000, subtract the $1,000 from it, which is the residual, and I divide it by 5 years. I get $1,800. So for straight line, I have $1,800 annual depreciation. For units of production, I have $900 annual depreciation. And for double declining balance, I have $4,000 of depreciation for that year. Again, 3 different methods, 3 different depreciation expense items. And it's very important that they're all correct. It all depends on what method that particular organization wants to assign to their asset. And you can see all 3 numbers are very, very different. And you can also notice that when you're thinking about how to calculate these, straight line method and the double declining method considers, we have to think about the double declining method does not, but the units of production method and the straight line method uses the residual value as part of the calculation, whereas the double declining does not. It uses the book value. So that's interesting differences. So when you're going through your chapter and you're reading it, be aware of those differences because they could be very important and it could really alter how something's calculated. And if you make a mistake, you can go back. How do I calculate the depreciation using double declining, and how is it different from straight line? How is it different from units of production method? So, as I mentioned before, it's an accelerated depreciation method, and the amount of depreciation is much, much higher, as you noted in my example. Now, whenever there's an asset that you put into service, most often assets are not put into service on the first day of the year. And sometimes you have to prorate it. And by all means, if your question in your homework assignment requires you to record depreciation for a partial year, note that you're going to be prorating it based on the number of months and using that logic when you're actually recording your partial year depreciation expense. Your project does, I think, provides you with the depreciation expense. It doesn't require you to calculate it, but using straight line, you could still do it on your own and confirm the amount that is on your project. Again, partial year is all about how much time has lapsed between the beginning of the year and when that asset was put into service and in the end of the year. And that's mostly important. You're not going to be complete. And again, the calculations that I provided you in this example were the annual depreciation. What if, looking at the instructions on your homework, you have to be careful. If it's asking you for 6 months or if it's asking you for 2 years, you have to record the depreciation each year and record the accumulated depreciation. And in the case of double declining, you have to make certain that you recompute your book value every year to ensure that you're using the right depreciable base when you're calculating the depreciation expense. It's just things that you need to think about when you're actually recording the transactions and what method you're using to be careful and not make a mistake. Now, revising your depreciation methods, again, if you're revising it, you're going to go forward. You're not going to go back. You're always going to go forward. If you're going to revise it, your life, etc., it's okay. You can do that. Just don't restate what you've done. Just take the change and go forward. That's mostly important. And one thing I do want to mention with depreciation, when you are repairing your asset or you're maintaining it like a vehicle, having to change your tires or have to change the oil or you have to replace your brakes, these are not, no way, capital expenditures. These are not going to be adding to the value of your asset. These are just improvements that are repair and maintenance type, and you're going to expense them. But if you take that asset and you extend its life, like a building, and you add a roof to that building, the life of that building has been substantially improved, and it will extend the life of the asset. As such, you will have to add that to the value of your asset and recompute your depreciation, simply because the asset is going to be the cost of improving and extending that life of that asset is going to alter your depreciation expense and extend its life. So that's very, very important. If you're just maintaining it, if you're repairing it, if you're something that wears out like brakes, you are not going to capitalize. You're going to expense it as repairs and maintenance. But if it makes that asset live longer, make it more efficient, you will have to capitalize that. So again, ordinary repairs and maintenance, we talked about that. Extraordinary repairs, and again, extending the life or making it more efficient is going to be the criteria. And when an asset is being discarded, you have to record the book value. Again, the book value of that asset is going to be the asset's cost minus its accumulated depreciation. And you're going to compare that with if you sell it. So if you take the book value and you sold it, the difference between the sales price and the book value is going to be your gain or loss. And again, we're not going to cover that in this particular course, but it's important to note that assets that are discarded, you have to remove them from the service and you have to reverse the accumulated depreciation and remove the asset. But at the same time, if it's sold, you have to record a gain or loss if that asset is removed and you sold that old asset. So again, if it's not fully depreciated, we're going to have to record the depreciation up to the point of that asset being removed and remove it from your records. Again, losses are going to be recorded, and again, or gains are going to be recorded. And again, we are just talking about this in theory because I'm not really sure if you're going to have any questions on your homework that relate to this. But understand, assets that are not fully depreciated and they remove, you are discarding it. you have to make certain that you reverse the asset off the books, meaning your accumulated depreciation is going to zero out, your asset itself is going to zero out, and that difference, if there's a difference between your accumulated depreciation and your asset value or your book value, you're gonna have to deal with a loss or a gain. And this is where we talk about gain or losses on the sale of your fixed assets. Again, book value of that asset. If the price of that book, of that item that your asset, if it's higher than the book value and you know how to calculate the book value, you're going to show a gain. If the book value of that asset is less than the selling price, you're going to show a loss. And again, a loss is going to be an expense and a gain is going to be other income. And that's how it will be shown. Again, natural resources, again, are assets that are used up. They deplete. And we're going to be showing those use of those items using more or less the units of production method of recording the depletion. Remember, this is not a fixed asset. This is going to be a natural resource that is used up, that requires a depletion. We are depleting our asset. We are not depreciating it. We are depleting, which is a very different term. So again, different terms, and we don't have to be able to understand what they mean. Remember, fixed assets we depreciate, natural resources we deplete because we use them up. They are there in the natural world. We can look at them, we can refine them, but at the end, they are going to go away. They are used up. They are depleted. So you will be quoting depletion versus depreciation. And know the difference between the two is what really going to be the most important thing to note here. It is a fixed asset. It's going to be used up, and we're going to record, again, the same as we would any other type of units of production type. The cost of the resource, how much did you pay for it, and how much are you going to extract. That's going to be your depletion rate, which will not change throughout the life of that asset or how much you have left. So we're going to take that rate and multiply how much we've removed to come up with our depletion. And remember, depletion is only for assets that are used up. So here we are, same as any other item is going to be accumulated up depletion. We're going to have our asset, which it would be probably petroleum or something else, and our accumulated depletion, which will give us our book value of that asset. Now we have intangible assets. Again, these are assets that are long-lived, but they have no physical substance and includes copyrights, patents, trademarks, and goodwill. A patent is, again, you made something. It's yours, and you patent the rights to it, and no one can take that right from you. And that's a value to you. Copyrights, like anything else, you write a book, you have some kind of intellectual rights. That's a copyright. And it's yours, it's a value to you, and you have to record out in your books. Trademark is like Coca-Cola, the trademarks. Goodwill is more or less a value of a business that you've purchased or acquired. No, now, today we do not record changes in goodwill. Like land, it basically stays on the books as a set number, and it's not changed unless the value of that asset has been modified. If it has lost value, then you'll record or you'll adjust that asset downward. That's the same is true for land, but goodwill and land are not allocated. The cost of that life is not allocated over a period of time because it doesn't have a life. It has no life. It's kind of indefinite, and it's really not going to be recorded. But with any intangible, you're going to have to deal with determining how to record those intangible assets, and then whether or not we amortize them, whether or not we do not amortize them. Depreciation no longer is amortized. We just let it sit there. So again, intangible assets are going to be amortized using the straight line method, generally speaking. And I believe in this course we're going to be using the general method, and that's going to be straight line, and you know it's going to be the cost minus its value at the end of its life divided by the life, and that's it. But again, another term, amortization. Intangible assets are amortized. Assets that are used up are depleted. Assets that are fixed are depreciated, and know those differences. And this, the rest of this is really about the different types of assets that are intangible. Again, we want to make certain that any type of patent that you have, and you have to defend that patent, and if it's legally upheld by a court, the cost to maintain that patent or to defend that patent must most certainly be expensed if it was not held in court, meaning you lost your the patent was challenged and you lost in the lawsuit. You'll have to expense it. However, if the patent was successfully defended in court, then you will amortize it as part of the cost of the patent itself. And that's the only thing that I think most certainly will be a little different than anything else. With patents, if you defend it, and if you defend it successfully, it becomes an asset to you and you amortize it. Otherwise, it's an expense. And the same with copyrights and trademarks, same thing. They are yours and by right, and they have a value assigned to you, and you have a life that's 70 years beyond the person's death who wrote it. So if I wrote a book, which I have, my book is most certainly my copyright. It's mine. No one can use it without my permission, and it will remain mine 70 years after I'm dead. Very, very important. And again, just know what costs are included in copyrights and patents, and I think that would be most important for you. But more than anything, just note that these assets will be amortized, generally speaking. Goodwill is not. It is created by favorable information on your organization when there's a purchase or a sale, and it is not amortized. Generally, if the goodwill is determined to be impaired, we will write it down to the value that it is determined. However, you will not amortize it on an annual basis as you would any other asset, intangible or otherwise. So I want to finish this chapter with letting you know that this is probably the most fun chapter because it's really relevant. I think it's kind of interesting of all the things that you can learn and the different terms that you'll be exposed to. But note that fixed assets are tangible, that you can touch them. They are part of operating the organization. There are some intangible assets, and they include obviously goodwill and patents and copyrights, etc., and they're amortized. Then there are some assets that run out or deplete, and they are going to be for natural resources, and you will record depletion, almost always using some form of units of production method to show how much is being used up. Your assets that are long-lived and fixed, obviously you will depreciate them, and you will be recording depreciation expense using your sum of years or depreciation, or you're using some type of straight line or double declining methods. And understanding the terms associated with each one of these methods are going to be very important to you. I hope this chapter is very useful to you, and if you have any questions, by all means ask them, and I will do my best to help you. Thank you very much for listening to this very long video, and I hope to see you in the next one.